so welcome to lesson 5. This one's going to be about asset allocation. We're getting to the point now where we've covered a lot of things. Now it's about putting together investments, how to put together your own portfolio, and asset allocation is really, really important. But before I do that, I'll give you an update on, if you didn't see my post on my Facebook page, but I'll give you an update on AJ because everybody seems to be asking. Okay, so what happened is when I left the class here Wednesday night, I got home and then my niece called me and said, was giving me an update on AJ as of Wednesday night. And what happened is his leg swelled up so much that he could only put his leg straight. He couldn't even bend it. And she had to literally pick him up and carry him outside just to go to the bathroom. That's how bad his leg got. So I went over there on Thursday morning to see how he was doing. And I unlocked the door and I walk in, and AJ's in the kennel in the kitchen that's right by the door. And here he is, standing in the kennel, his tail's wagging back and forth. He looks at me like, oh boy, and then I open the kennel door, and he trots out with a little limp, goes to the back door, looking for me, let's go, out to the trail. It was unbelievable. I literally got a tear in my eye. It was so cool to see. The swelling went down, and we went out to the trail, and we went for a walk. And we met some other people with other dogs, and AJ was fine with all those dogs. He's just back to his normal self. So don't you wish we as human beings could recover like that? So that was good news. It's really interesting because Jane's been nice enough with the YouTube thing, and I was a little bit uneasy when she put the first one on my YouTube, on my Facebook page, because we don't have, I tried to do a disclaimer in the start of each class, but it's like I wanted to have a disclaimer on the videos because they're going to be out there for anyone, anywhere who doesn't even know me, and which is great, but they don't know me. And I want to always make that clear that, I'm not a financial planner. This is informational. If I give you an opinion that, oh yeah, I really like the total stock market index fund, well, it doesn't mean that it's not going to go down. You know what I mean? It's a total stock market index fund. So if the market goes down, it's going to go down, right? And so they always have in these disclaimers, there's a chance that it could go. But anyway, I was reminded when I was walking AJ yesterday, listening to the Bob and Tom show, because they were going on and on and on about this guy in California. I've never heard of this, but there's a barbecue sauce or something like that called Texas Pete's. And this guy went out to the store and bought a bottle of Texas Pete barbecue sauce. And now he's suing the company because he found out that Texas Pete's not made in Texas. On the bottle it says it's made in North Carolina. So he's suing for damages because he's been misled that he's not getting the authentic Texas product. And I'm going like, my gosh, if we've gotten to be, you're suing over something like that, and I'm talking about investments. I make it very clear that I am not a financial planner. And it reminded me that there are people out there, and I'm thinking to myself, who is the attorney that's so desperate for work that he wouldn't tell this guy? And it's kind of funny too, because they were kicking this around, and one of the guys said, I probably shouldn't say this, but I'm like Buddy Hackett. You ever seen Buddy Hackett when he's on Johnny Carson? They're always edging him on to tell one of those jokes that are right on the edge of being censored, and Johnny's like, don't do it, buddy, don't do it. But okay, but anyway, they were bantering back and forth about how to handle this, and one of the comedians on there said, well, I think that judge should sentence that guy to a medical procedure in which you flush yourself out, but instead of using water, use Tabasco sauce. But anyway, hope you don't have to edit that out, Jane. But I laugh because, really, it's gotten to be that point. Okay, so AJ's great. Got my disclaimer in for any people on Zoom. And the other thing is I got contacted today. The Fond du Lac Rec Department asked me to do a class last summer. That was the first one I went back after 2.5 years at, down in Fond du Lac at the Thyssen Middle School. And it went so well that they want me to come back again. So some dates that were open, I'm going to do 6 classes. They'll start January 30th for 6 weeks. There's 6 p.m. at Thyssen Middle School. It's a fabulous facility. I mean, it's really, really awesome. You just go down Pioneer Drive to the east side of the city. It's right off the Pioneer Drive, and you parking lot right next to the door, and it's really big. I mean, it's like about the size of Oshkosh North Auditorium. Really good acoustics. So, you know, I'm going to do a 6-week series there, and so if you want to go into that one, it'll be available. Let other people know about it. Anyway, let's see. Anything else? I don't think I forgot anything. Okay, so asset allocation. This is like homework I'm giving you, because most people have a hard time even reading their statements. But most companies now will give you kind of this pie chart, designating how much you have in equities, how much you have in cash, and how much you have in fixed income. That's what we're talking about with asset allocation. So what I used to do back when I had a more complicated portfolio is like I would just get a piece of paper, and then I would draw a line down the middle, and I put equities and I put fixed income. And under fixed income, it'd be the money that I had in the bank, money if you had money in CDs, any money that you have in bond investments, that's kind of fixed income. And then equities would be any mutual funds that are in the stock market. And if you have like a balanced fund, usually balanced funds are allocated about 60% in the stock market and 40% in bonds. That's how you'd figure that out. So, and most people don't do this. What you do is you have to, asset allocation is so darn important in handling, getting to your ultimate goal. I have a chart here which really points that out. It's like the percentage of one's portfolio movement over time is how much of it is explained by security selection or market timing. Switches you make it in market timing, you're doing that. Roughly about 9%. But 91% of the movement that you have over the course of your lifetime has to do with your asset allocation. And so it's like at one time I was sitting on a board for a company and their company retirement plan. And I remember when I first got on this company retirement plan, everybody was complaining, or the people on the board were complaining, we just can't get the young people to invest in the stock market mutual funds that we're offering. They seem to want to put their money in even a money market account or what's called the stable fund. They want to get the 1 or 2%. They don't want to have any movement. They don't want to have any risk, and so forth. And that is a huge problem. That is an absolute huge problem. And it's like, just think about this. Like, who are the people that you would think would take the most risk with their money? You'd think it would be young people, right? But yet, how many young people do you see in the Target parking lot lining up to get on the buses to go to the casinos? Right? It's like older people. It's really ironic. It's like you find that many times people who shouldn't be taking the risk are taking a lot of risk. And why are they taking it? Because they realize that they're probably going to never have enough to retire on or maintain growth enough to not run out of money, because they invested so conservatively when they were young that they never grew enough money, and now they want to make it up. It doesn't work that way. When you're young, you need to be taking maximum risk. That's like, I think I talked about that. It's about the capital that you possess. When you're young, you possess a tremendous amount of human capital. And it's that human capital is your youth, your talents, your energy. And so you can pay your bills by earning money by using those talents and turning those talents into capital, into money. But then ultimately your plan is to get to that point where you don't have to use that human capital. You've built up capital assets in the stock and the bond market upon which you can live on. So that's the plan. But so many people do it backwards, and then they think about it. We talked in the first lesson about the rule of 72. So if you're a young person and you're a maximum saver, and so let's say you even save like $10,000 or $15,000 a year. Okay, that sounds like a lot of savings. And it is a good amount of savings for someone in their 20s. And then you put it into a money market account, or you put it into what's called those stable funds, and you're guaranteed 2%, or you're guaranteed 3%. Use the rule of 32, or rule of 72. You divide 3% into the number 72, and what do you get? 26 years for your money to double. So you put $15,000 in there, and it hasn't grown to $30,000 until you're like 56 or 60 years old. That's not enough growth. You're doing all the right things. You're working hard. You're saving a tremendous amount of money, but you're not growing it because you're not investing it in an asset that's going to grow. Your asset allocation is wrong. And so the first thing you need to do is get a handle on your asset allocation. And so if you're married, you need to sit down as a couple and get a simple piece of paper, draw a line down the middle, and say, how much do we have in the stock market? How much do we have in fixed income? Because you're working as a team. You need to have a joint figure of your asset allocation. And I mean, I've seen it all too. I've had people that I've talked to, and the wife, she's investing in the stock market, and then the husband, he's investing in his investments, and then they're competing with each other and trying to. They're not paying any attention to an asset allocation plan. They're competing against each other. Who could beat the other one? I mean, that's not the point. The point is to be smart and have a lifetime plan that's going to get you where you want to go. And that's what asset allocation is. So, as I said, doing everything right. What is doing everything right? It's like saving enough. And I'm going to talk a little bit more about that next week. But, I mean, as a young person, putting at least 10% of your earnings away into investments of some kind. And as you get older, bumping it up even more if you can. And then you doing it at low cost. And then you're doing it tax efficiently. And I'm going to cover it next week. I'll talk a little bit about the IRAs and the 401ks or the company retirement plans. What's the best strategy? Where should I go? There's things that you need to consider on which way you want to go. And so in doing it tax efficiently. And then the final thing is like the asset allocation. And so today is really to explain to you the history of the historical returns on asset allocation. And so you got an idea of what you can expect to happen as markets move up and down and on your long-term plan. In fact, it's the things that I've learned that's really in looking at the figures of asset allocation that can help me to make decisions on when to rebalance and when to move from a bond fund that's ultra short term to a longer one. And by the way, I will, there is going to be a day, and it could possibly be within the next 6 months, at which I will be moving from that ultra short term bond fund to one of the intermediate ones. In fact, I was on Vanguard's website last night, and it kind of really, because, okay, people think of me, I'm this investment guy. You know, I must be in tune with what's going on every day with the stock market. And I'm really looking at my investments. How much is the total stock market? How much did it go up today or down to? I couldn't tell you any of that because I don't look at that stuff. I don't pay that much attention to it on a daily basis. Why? Because I don't think I need to. But for the sake of a discussion in this class, I wanted to talk a little bit, you know, this thing about with bonds. There's going to be a tremendous opportunity in bonds. And it is moving from these ultra short-term bond funds or a money market account to an intermediate one. And so I looked at Vanguard in their intermediate, one of the funds that I've used in the past, I think is really good, is the intermediate investment grade bond fund. So what they do, it's intermediate term bonds, and they're investment grade, so there's super high quality bonds in there. And I have used that one in the past as an intermediate term bond fund. And I believe it has a duration in the 5s. And when I looked at that yesterday, it was actually for the year down 17%. And so it has really gotten hammered, which makes it to me even a tremendous buying opportunity on it. The yield on it was well over 5%, crowding going up to 6%. And so that has the tremendous, if interest rates really come down because of the effect of what the Federal Reserve's doing, then you're going to see a tremendous capital appreciation in that bond fund. And so the things that I've learned, the things that I watched, if you go back to the lesson I did last week, the Federal Reserve policy, the jobs numbers, because I've had multiple people ask me, like, how do you time that? And the things that I'm going to be watching is the jobs numbers. And when the Federal Reserve, if they raise a couple more times, it's definitely, in fact, I talked to a couple of my friends that are business people and local business people. And they've said they've seen a slowdown and the traffic coming into their businesses. So the Federal Reserve rates that have been initiated so far are starting to take effect, but when the hammer really comes down, then you're going to see those job numbers go from 100 or 200 or 300,000 jobs per month going down to 0. I mean, that will be a definite signal that the economy is really teetering on a recession. And even if we go into a recession, even before that, interest rates will start coming down because it definitely is an anti-inflationary signal. And so that's probably the things that I'm looking for. I'm looking at maybe 1 or 2 more rate hikes in the Federal Reserve, and especially those job numbers. So as a class, I would say at this point in the cycle, as a bond investor, pay attention to those job numbers because they are a definite signal. Companies aren't hiring if they don't have the work. In fact, companies are laying off if they see tremendous weakness. And so that will be a big help in giving you some idea when to make that transition if you're in short term to going to it. And it'll really help you on the bond side. Okay, and I'll post that on my Facebook page. And once again, this is not a recommendation. It's just what I'm doing. I love to have, that's the great thing about not getting paid for what I do. Because I can speak freely. I can talk about Vanguard, or I could talk about Fidelity, or I could talk about Schwab, because they're not paying me. You know what I mean? And I can talk about the Total Stock Market Index Fund because I use it and I'm not getting any money back from it. This is just my experience, and I have the freedom of expressing my opinion because thank God we live in this country where we can do that yet, you know? So this is just my plan in which I share with the community, and you can decide what you want to do. But I'm right. But anyway. Okay, let's follow through with asset allocation. So as I said, do your homework, have a handle on your asset allocation. I'll get into this more next week, but one of the things that I will be talking about a lot next week is simplification of what you're doing. I mean, especially if you are in retirement. To me, there is no need to having money here and money there and money over here and money over there and trying to juggle all this stuff. You don't need a very, very complicated portfolio. In fact, even in this lesson, I talk about asset allocation. This whole deal about you can accomplish everything you possibly need to do with asset allocation with using just one fund. It's a fund of funds. They're called either a life strategy fund or a target retirement fund. A person, it's so simple now to have your whole financial portfolio professionally managed at tremendously low costs, and if you put them in IRAs tax efficiently, by just using a life strategy fund or a target retirement fund. And I'll get in more of that at the end of the class. But ultimately, it's so much easier to do asset allocation if you don't have stuff all over the place. And that should be a process that I'll get into more next week. So basically, here's the fundamentals of asset allocation. The fundamentals are you need to take risk. In other words, as an investor, you need to take risk. Because if you don't take risk, you probably won't get enough growth to even keep up with inflation. It's just as simple as that. I mean, it goes around this thought. The amount of risk the reward for the amount of risk is that you get the ups and downs of the market. Now, the safety penalty of not taking risk is the amount you lose each year when you avoid risk. So the reward for taking risk is that you're going to get a higher return than someone who just avoids risk. That's simple economics. And so when, a lot of people, when they retire, they get called up by a financial planner or someone, insurance guy, and they're talking about like an annuity. Wow, you can put your money in here, you can make all this money, and you'll never lose money, and you're taking no risk. So when they ask me, what do you think about that? And my answer to them is, if there actually was a place where you could put money into it, and you're going to get the returns of the stock market, and you're never going to lose money, and you're never at risk, why would anybody invest in anything else? Right? So what's the catch? Well, with all annuities, read the fine print. Because there is lots of catches to it. It's like twisting words to make you think you're not taking any risk. But to me, ultimately, going to an annuity where you're paying these super high expenses, and you're paying, you have all these strings attached to them. They're just, to me, they're tremendously risky because the returns you get on them just don't bear the reward for taking the risk. Yeah, you're investing in the stock market through them, but the expenses consume so much of the return that you're not getting the reward for the risk you take. You know what I mean? And ultimately, it's like my understanding with an annuity is you never lose money, but in order to not lose money, you have to die. Because it's like you're passing it on. But if you take money out of an annuity, you're not guaranteed the principal. You know what I mean? So there's just so many strings attached with them. The basic principle is there is no investment where you're going to get the return of the stock market and all that kind of stuff without taking risk involved of it. Okay? What is your tolerance for risk? So basically, you have this need to take risk, but then what is your tolerance? Everyone has a different tolerance for risk. Everyone in this room has a different tolerance for risk. But what I've learned is a person's tolerance for risk actually increases the more knowledgeable and the more information you have about what you're doing. If you're uncertain about what you're doing, if you don't have any understanding, then investing is very scary. Well, why is it going up? Why are we going down so much? Look at my bond fund, it's down 17%. I thought bonds were supposed to be safe. You know what I mean? Because you don't understand why this is happening. And it's happening for a reason. And it's not going to continue forever, but it's happening. And if you're educated why it's happening, you're understanding that you could have been expected of this happening. It's not shocking to you. Okay? So tolerance for risk is something that everyone has. And I have a very, very, very high tolerance for risk. Over the years, the more educated I become, and my tolerance for risk is off the chart. It is. Yet, I have a balanced portfolio. So, why? Because the investment time horizon states your ability to take risk. So what is your investment time horizon? It's not your age. It's not your age. It is the time at which you will be taking money or potentially need to take money from these investments. So keep this thought in mind no matter what age you are. So if you're watching this class and you're a 28-year-old newlywed and you're deciding how you're going to invest money. Well, basically, when you're that age, you actually have like two different portfolios. You have your portfolio that you're putting money away for potentially retirement. But then you should have another portfolio in which you're putting that money away, and I call it your rainy day portfolio. And that should be invested real conservatively. And something like a tax-free municipal bond fund. Someplace where you might get 3 or 4 or 5% interest on it. It's tax efficient, but it doesn't have the potential for explosive growth. But it also has limited volatility. Because this is your rainy day fund. Meaning you'll have the opportunity, or you're probably, okay, so I hate to say it, if you're 28 years old, you are going to face many rainy days. That's life. Life is filled with rainy days. What is a rainy day? Well, honey, I just had a fender bumper. I didn't look really, and I backed up, and I ran into this guy's car, and it's probably going to cost us a couple $1,000s to fix our car. That's a rainy day. Or honey, the washing machine just blew up. Oh man, I opened the refrigerator. All the stuff is rotten in there. Our refrigerator went back. I mean, these are rainy days. And you had to come up with $1,000 or $2,000. That's that portfolio. And because the time horizon could be one day or any day, that should be invested very conservatively. But the asset allocation that's put away for longer term things should be very aggressive, because you have that human capital that you're living on, and your long-term goal is maximum growth, and you're not going to get that by putting it in a bond fund. Okay, so you need to, the interaction of these three things are the principles or the fundamentals that you bounce back and forth when you're considering asset allocation. So let's delve a little more into this need to take risk. So if you look at a $10,000 investment in stocks, bonds, and savings. Well, historically, okay, this is another thing that should help you going forward as investors. There is a principle that or I don't know what the term to put to it, but there's something called reversion to the mean. And in investing, reversion to the mean means that historically, going back hundreds of years, you find that different investments revert to a mean return. And for the stock market, the mean return to the US stock market over the last 100 and some years has been around 10%. The mean return for bonds, talking intermediate term bonds, has been around 5%. And the mean return for savings accounts has been around 3%. So here's the interesting thing about reversion to the mean. The last time you got 3% in a savings account was 20 some years ago, right? So we are just now reverting to a mean return. So everybody's like all shook up because interest rates have gone up so much. But in reality, interest rates are just reverting to the mean normal return historically of interest rates. And that's why I'm optimistic going forward as an investor in both the stock and the bond market, is that the rates that have increased recently actually are reverting back to what has historically been the normal interest rates that this economy has handled and grown with for hundreds of years. So it isn't the end of the world that the Federal Reserve has raised interest rates to the 3% plus rate. And it's not the end of the world that interest rates have risen. History has proven that our economy can run just fine with normal interest rates. So let's talk about the return. We're talking about risk here. So this would be on the highest level of risk, investing in the stock market, like a total stock market index fund. On a scale of 1 to 10, I think Vanguard puts it at 9 or 8. Okay? Bonds, that's right in the middle. You're talking 5, 6. And then savings is basically zero risk because savings accounts are insured, or a money market account has a $1 share price, so it's very, very low risk. So how would your money have grown over a 40-year period? If you put $10,000, assuming no expenses on it, assuming no taxes, a $10,000 invested in the stock market would have compounded out to about almost $500,000. 5% in bonds, it would have only grown to about $80,000. If you put it in a savings account, it would have grown to about $30,000. So look at the difference on the reward side for taking the risk by investing in the stock market. And when can you take that risk? When you're young and you have the human capital and the ability to earn and pay so you're not touching it. But when you retire and you're taking money from investments, you know, the amount you have here, you don't want to be taking them out when the market's down. You want to have investments in here so that you can take them out of there and let the stock market do its thing and not be selling during downturn volatility. Now, if you understand this, you don't get all shook up when you have bear markets. Historically, from 1926 to 2008, this is the range in volatility on those three assets: stock market, bond market, and cash. You see that the stock market, it's almost 100% from zero. I mean, it's gone up over 40%, but it's gone down 50%. So you have a tremendous range. The bond market, you can see, is less than half. And then there's been no down years in cash, obviously. But once again, let me put a footnote on that. We're having a tremendous down year in cash right now. Even though your money market account might be paying you 3%, inflation is 8%. So in real terms, you're losing 5% even in cash. So there's no year where on the surface it says you have a negative return, but in real investment terms or real money terms, you're losing ground in cash because inflation is consuming your return. So then when you go out to 5 years, look at how much the volatility range on the stock market is reduced. And then bonds, considerably, cash. And when you go out to 10 years, there's been no 10-year period where you've had negative returns in the stock market. So you know, even that lost decade from 2000 to 2009 is actually, if you the share price, if you measure the stock market by share price, it really didn't do anything. But then you had a 2% or 3% dividend rate each year, which means that you had positive return, including dividends. So you can see the volatility on the downside. The more time you give investments in the stock market and in the bond market, the less chance that you're going to have downward losses. S&P 500 from 1926 to 2002, on a one-year basis, it advances about 70% of the time, and it declines about 30% of the time. On a 5-year basis, 90% of the time, you have positive returns if you put money in the stock market, and about 10% declining. On a 10-year basis, 97% of the time, you're going to have advances, and 3% of the time, you may have declines. But if you include dividends, then you're not going to have declines. You get it? So investing is about statistical probabilities. In other words, there's no 100% thing you could say absolute. There's statistical probabilities. And doing the right thing with asset allocation, using something like a total stock market index fund or a high quality bond fund, is giving you and you increase your statistical probability of success by lowering your costs and doing it tax efficiently. You increase your statistical chance for success by diversifying instead of putting all your eggs in one basket or picking this stock and that stock. Diversification gives you higher probabilities for success. That's the way you have to think. There's no way to do something that's just absolute and you're 100% guaranteed. There's always going to be random events that take place, but it's giving you the best probability statistically. So let's talk. One of the good things is to look at some of the volatility, historical ranges, bear markets, how long they take to recover. So if you go back to the bear market of 1956, the market declined about over 20%, and it took about a year and a half before it started to advance again. 1968, 36% decline, and I actually was in high school in 1968. I didn't have a clue this happened. That's the great thing about being young. All these major problems that are going on in the world, you didn't have any clue. But 1968, I didn't have any clue about the 36 decline, but it took about a year and a half. 1973 was a particularly bad one. I was in college. Well, I might have graduated from college in 1972, but I don't remember that 48% decline either. I was in my 20s, but I don't remember it. And that took almost 2 years. 1976, went down just about 20%. That took a year and a half. 1981, 25%. That took about a year and a half. 1987, that one I do remember, because by that time I had already delved into investing. I had built a small portfolio. And back then I had no idea what I was doing. I was watching it all the time. I would write down how much I went up that day and down that day. I was one of those guys. I mean, it was really interesting to me. So it wasn't that I was so fixated on, but I was trying to learn here. And I thought the best way to learn is to really watch it every day, which is the best way not to learn. But I did learn in spite of that. But I remember how it was shocking in a matter of days how the market went down 33%. But that only took 3 months and it bounced back. I mean, I learned so many lessons from there. I learned the power of bonds. that my bond investments at that time were doing really well, where the stock market was doing, and then in 3 months it was all over. We were already going back to recovery. So, I learned that lesson. Then 2000 was particularly brutal, 47%. 2008 I don't have on here, 48%. And the one in 2000 took over almost 3 years before it really returned around and started coming out of it. So you can see there's all kinds of different ranges here, but that year and a half seems to be pretty in there. We actually had a quick recession when the pandemic hit. That was so short. It was a matter of months, and we came back from that one that most people didn't even consider it a bear market. So you never know, but you do know that they will come back. So let's say that you have different portfolios. How are they affected by bear markets? So the most recent bad one we had was 2009. So if you had an asset allocation of 90% in the stock market and 10% in bonds. Now, here's something that you need to think about. I'm showing you this is research. This is stuff that I've gotten from books and off articles on the internet. And all these articles talk about the stock market and the bond market. So what measures are they using for the stock market and the bond market? They're actually using the indexes. So the historical data, which people use to strategize with investing, is based off of indexes of those particular assets. And yet, people sit down, say, with a financial planner, and then they're putting together portfolios. But are they using indexes with almost no expenses? No, you're paying the financial planner, and they're probably getting 1%, and then you're paying for the mutual funds and their management fee, transaction costs, which could be another 2%. And so then you're looking at, it could be 2 to 3% less than these. And so when you're creating these models for potential returns and how things like change, it's only relevant if you're using indexes. But how many people are actually putting together portfolios that are index-based? They're using portfolios that have all these expenses, and then you throw in taxes too. So once again, you could be doing the right thing, but if you don't have them tax efficient and you don't have the expenses, all this information is basically useless because it won't turn out this way. Once again, going back to my premise of simplicity and sticking to indexes for the consistency of the value of using historical data. Does that make any sense to you? Are you following my thoughts? Sometimes I wonder if because to me it makes perfect sense. Okay, so let's say a portfolio of 90% in stocks and 10% in bonds. $100,000 invested in 2008. You got hit by that bear market, went down 47%. So yes, if you had $100,000 in the total stock market index fund, it went down to $58,000 some dollars. This wonderful investment I'm talking about, that is just the way to go, it went down 50%. Who wants that, right? But that's just the way it is. But the great news is you didn't go down 52 or 51. You went down this. You went down the return of the stock market. All right, so basically, yes, indexes go down. So you're down to 58,000. By 2017, it had recovered and it was up to $227,000. 70% in stocks and 30% in bonds, okay, it went down to 67. So the value of adding 20% more in bonds reduced the volatility by over $10,000. Okay? And that came back to about 209. So because you're taking less risk, you didn't bounce back as high. But by adding safety, you reduce the downward volatility. That's the price you pay for reducing your asset allocation. Okay? Then, if you go to the balanced portfolio, which is the target I use, you went down to 76,000, so considerably less than this. And you still bounce back to almost 190,000. So my point is, I am more than willing at this stage in my life where I'm taking money from my portfolio to pay my bills and to buy the things I want, to sacrifice the potential of making another $30,000 for the benefit of, number one, being able to take money from bonds when the stock market is down, and reducing the downward volatility, which would cause me to lose sleep at night. Because that's what it does. Even though, I'm telling you, even though I have this super high tolerance for risk, I have enough investment knowledge to understand how this stuff is working, that it's going to come back. If I had my portfolio with the amount of money that I had in my stock portfolio, and I saw that drop 50% because I was 100% in the stock market, I wouldn't be sleeping so good. Simply, that's the way it is. And that's why asset allocation is so important, is to give you that peace of mind, not to be jerking around, and to have a plan that you know consistently is going to protect you on the downside, but it also is going to give you the growth to compensate for inflation and stuff like that, so you don't run out of money. Okay, so what are the annual variations for various asset allocations over long periods of time? So if you have an asset allocation that is very conservative, it's 80% in bonds and 20% in stocks. So this would be someone that is ultra conservative, probably 90 some years old. You know, okay, the historical range is the best year for a portfolio from 1926 to 2013. The best total return for a portfolio like this was almost 30% in 1 year. Wow. So why this risk if on one particular year you did 30%? That is fantastic, isn't it? But that was just 1 year. The worst was down 10%. So you can see pretty narrow here. And the average was 6.7% return. Okay, so you can see that when we talk about reversion to the mean, over long periods of time, bonds have produced way better returns than we've seen over the last 10 or 15 years. So the point that as an investor, what you have to do is you have to not get locked up in what's called recency bias. That's what this lesson I'm trying to get across to you is. You need to think longer term and not get wrapped up with what's going on just recently. And by recent, bonds have really had really low interest rates for, 10 or 15 years now. And so many people think that's the way bonds are. No, historically you can see that if an 80% in bonds and 20% in stocks averages 6.7%, in order for that to happen, bonds have had to have much higher returns historically over long periods of time, right? Okay, and that's what I think we're going back to, a more normal. And for people who are retired, this should be absolutely wonderful news. Wonderful news in that they're actually bonds is going to be a powerful part of their portfolio besides just an insurance policy for volatility, because you're going to actually get interest from them. That's meaningful. Okay, the most conservative is 90% in bonds and 10% in stocks. That actually had a higher year, and I think that's skewed by the fact that we had that 1970s where interest rates were so high that kind of skewed this and brought the mean up on that to 31%. But the average return, as you would expect, was lower than you're taking more risk here. And the best year was 8.2. So let's get up to more meaningful asset allocations. Here we have the balanced portfolio, which I advocate. Now, once again, when I talk about a balanced portfolio, my target asset allocation is 50% in the stock market, 50% in bonds, because I'm living on my portfolio. But that doesn't mean that I call up Vanguard every day. Is my portfolio 50-50? Do I have $10 on the positive side? You know, no. I actually, once again, I give myself a target of 50-50 with a window of about 8% to 9% up or down from that target. In other words, I don't sit there and rebalance. So if you have a target of 80% in the stock market and 20% in bonds, it doesn't mean that you have to micromanage it. All of a sudden you're 82%, I need to rebalance. No, you can let that drift roughly about 8% either way without rebalancing, unless you really want to, but I don't want to. I kind of let it drift within that window. It's just my target, okay? So if I'm using this as my model, and we looked at 50-50, the best year was 32.3, and the worst was down 22.5. So when I say a balanced portfolio, you put that in there to reduce the volatility. Lots of people would say, wow, going down 22%, I can't handle that. But the truth of the matter is that 50-50 tells us historically that you can go down 22%. My personal experience, I remember I was doing this lesson. I didn't bring that chart along with me, but back in the bear market of 2000, and I think that's pretty much a model for one of the most severe bear markets that we've had in modern times in the United States. We were down roughly like 50%. Okay, so what I did was I took the absolute low price that at that time I was using the Jennie Mae fund and I was using the total stock market index fund. And so I looked at, historically I went to Vanguard and I found what was the lows of those particular things, or what was the price of those, or return on those at the lowest point of that bear market. And so the total stock market index fund was down roughly 50%, and the bond fund was up, I can't remember how much it was. But I sat there and I looked at it, and I realized at the worst, my 50-50 mix in that bear market was down about 17 or 18%. So I guess it depends on the investments you have, but roughly to give you some of the volatility. So don't say that, oh yeah, Jeff Kemp said go to a 50-50 mix and you're going to reduce your volatility. You're still going to have volatility. And to some people, 20% down is like the end of the world. But if 20% down is the end of the world, then your tolerance for risk is not realistic if you want to have a portfolio that's going to grow or not run out of money. I'm going to get into that more next week because I have a really good chart showing you the statistical probability of running out of money based on your asset allocation when you retire. And it's really quite dramatic. When people get too conservative when they retire because they don't want to see any volatility, they are statistically giving them a really high probability that that money will not last 30 years. Okay, so this gives you the idea of this model. So an average return, 8.8. So to me, if you get the average is 8.8, what look at the sweet spot that puts you in. So if you're withdrawing 4 or 5% from your portfolio to live on, and your portfolio is growing on an average over the 30 years of your retirement at around almost 9%, you're actually probably going to end up, your portfolio is going to be growing rather than retreating. Now, there might be some years when it's down, when you have a bear market, but ultimately over time, you have giving yourself a very high probability of not running out of money. Okay, then a 60-40, that's another one. So if you look at that, the best year was 36, so about 4% more. Average return, actually, I don't know, it's weird. I can't, don't ask me to explain it, but the average return for taking more risk here is less than the 50-50 mix. And I think that goes back to that 15-year period when we had hyperinflation and super high interest rates and bonds actually return more than stocks. I think that probably explains some of that. And on the downside, you paid more, so that showed up right. This is just kind of weird. Don't ask me to explain it. Okay, so let's get into a younger person's asset allocation. So if you're 90-10, and I think that's a really good model for someone that's in their 40s, 50s, 20s, 40s, 50s. Best year, almost 50%. Worst year, down almost 40%. And average return, right around 10%. And 0% in bonds, 100% in stocks. Best year, 54.2%. Worst year, down 43%. So what you can see from these models are the reward for taking more risk progressively is, you get a higher average, and you have the booming years much more. But then on the downside, the volatility on the downside is much higher too, with more risk. That's part of playing the game. What's really interesting is you look at this 54%, the best year. Let's see. This is 100% in stocks. This was 1960 to 2005. So this is a different time period, so that this best year happened before 1960. But what's really interesting is you can see the same characteristics here, but the average return was 10.5. So if you look at someone who's paying 2% what's the average return? Drops down to what, 8.5? So you would have to go all the way back to an asset allocation. By being 50-50, I'm actually outperforming someone, statistically speaking, who gets an average return of 10.5 and is paying 2% in expenses. You see why, when we're considering risk, paying these expenses of managing things actually enhances the risk of what you're doing as far as the total return you're going to get. That's why I keep talking about risk. And then if someone is talking to you about asset allocation and isn't addressing the expense thing, then all these models are kind of meaningless because the expenses you're paying are skewing that. This is from Burt McKeel's book. And I like the way he calls it. The volatility you expect on the downside. He calls it the threshold for pain. So if you have about 20% in equities, then you're going to have about 5% down. If you got 30% in equities, about 10% down. 40% in equities, so 40% in stocks and 60% in bonds, about 15%. 50-50, your target is around 20%. 60, it bounces up to 25. 70, 30, and 90% in the stock market. So young people should fully expect there can be at any time 40 and 50% declines, and it's not the end of the world. Get your head out of the recency bias. It will come back because markets revert to the mean. There have been so many times when, like, even back between 2000 and 2009, I mean, the total stock market index fund was down, then it was back up, then it was down, and so the total return was somewhere, you know, like 0, and it was 2% if you talk about dividends. And in my mind, all I was thinking is, wow, a 10-year period where the return was so much below mean, we have the potential for a tremendous bull market. And what happened from 2009 all the way up to 2020? Tremendous bull market. And actually now the markets have just reverted to their mean, you know, and even with this downturn we've had right here, the mean is, we're still probably in the 9s yet. All right. So interestingly, how do investors actually do when we're in bear markets or the markets get really volatile? This was an interesting chart. What they looked at investors, and the time period was 1997 to 2011. How did investors behave in their investments when the market got very volatile? So you measure volatility by standard deviation. So if you look at a particular fund, how much did it deviate from the return of the stock market or its index? So funds with a milder standard deviation of about 15, those funds over that time period returned 159%. But how did the investors in these funds, what did they return? Well, they returned about 136.2. So that means that they pulled out during volatile times, and so their return was diminished. So they lagged the market by about 23%. Okay, so the standard deviation jumps up to 17.6. Average return on those was about 142, a little less than this one, but this was 140, that's what happened. Investors, because it was a little more volatile, their return dropped to 103. They underperformed by about 40%. As the volatility of a fund increased to a deviation of about 19.5, those funds actually returned 146.6. Investors in those funds returned 96.1. They lagged by 50%. And the most volatile, with a standard deviation of 28.2, those funds returned 205% on average. And investors in those funds only returned about 122% on average. They lagged by 82%. Once again, the tolerance for risk. And the more volatile investments are, you get into these really, really volatile investments, investors can't handle it and they pull money out and then they lag the return of the investments. That's why I advocate people, you know, once again, getting more educated, but don't go into investment portfolios in which the asset allocation causes you to lose sleep. So, you know, as a younger person, I mean, I didn't understand so much, but when I did, one thing I did understand, you have to go back to when I was younger. My youth, my 20s and 30s, were the bond market actually was way more attractive than the stock market. The returns in the stock market between the 1970s and early 80s was very, very poor, and I could get 8-9% in a CD or a savings bond. And so my portfolio, my asset allocation as a younger person was never 90% in the stock market, you know, because of the period we were in. But, you know, eventually as I learned more, I realized that then I started investing more and more in the stock market, and thank God, because we're talking about the 80s and the 2000s. So I guess I was born with a silver spoon in my mouth. Even though I did the wrong thing, I did the right thing. Does that make any sense? Because of the time period. But basically, but the one thing that I will say is that I've always been consistent, not pulling money in and out and staying with things and not trying to time things that just because we're in a bear market necessarily. So one of the things that you really need to do as an investor is, if you have a plan, rebalancing. And this is particularly important for people who are within 5 years of retirement and getting that model portfolio, which I advocate could be 60-40 if you're in your 50s and early 60s, or it could be 50-50 depending on what you want to live with. But sticking to that plan and giving yourself about 8% and then rebalancing. And so this chart, this is an interesting chart because it shows a time period from 1989 to 2006. And we have two different investors. One has a target of 50-50 and rebalances on an annual basis, and the other one just lets it drift. It's really interesting to see what happens. Okay, so the year's 1989, they both have $100,000 in their portfolio. Okay, 10 years later, this person rebalances every year. Takes money out of the stock market, puts it into bonds, because this was a high growth period in the stock market. And this person just says, you know what, I'm doing really well, I'm just going to let it ride. Okay, so this one rebalances, this one doesn't. Okay, so by 1999, this person's portfolio, because the stock market did so much better than the bond market over that 10-year period, his stock asset allocation went from 50-50 to 73% stocks and 27% bonds. This person stayed 50-50. So what advantage did this person experience over that 10-year period? He basically made about $30,000 more. So he was rewarded for not rebalancing over that 10-year period by making $30,000 more. And then along comes the bear market of 2000. And so this person declined 17%, where this person only declined about 5%. Okay? So we keep going forward up to 2006. This person kept rebalancing and stayed 50-50 at the end of the year and went into the next year 50-50. This person just didn't do anything, just let it go yet. Well, by 2006, this recovered, so he was still 66% in the stock market and 34% in bonds. So he still was allocated like 16% more in stocks than the other guy. But this person, having experienced this decline and has been taking more risk for all these years, this person has $439,000 in his portfolio, and this one has $444,000. So the person who rebalanced actually outperformed the person who didn't rebalance, even though the person who didn't rebalance was taking more risk, experienced more volatility, and is continuing to take more risk. He's not getting rewarded for it. That's the power of rebalancing. Because when you rebalance, and how do you do that? Okay, when the market's going up, what do you think changes in your asset allocation? The stock side, right? Just like right here. So you're taking money that you've made in the stock market, locking it up into an investment that doesn't have the volatility and is probably going to grow during the bad times. So you don't have these big lows. So you're actually reinvesting and locking in those gains, but you're still giving yourself, because you have 50% in the stock market, you're still capturing a lot of the growth. You can see even here, I mean, he only underperformed by $30,000. Remember, they both started out with $100,000. You made $234,000. It's not that you're sacrificing all this growth. You get what I'm saying? Okay, so that's really, really interesting. So as I said, it's gotten so easy for an investor to accomplish everything I teach in this class by using a target retirement fund or potentially a life strategy fund. So I just want to explain those, because let's go back to when I started this class. I said that I sat on this board and we were really, really frustrated with the fact that so many of the young people were not putting money in any kind of stock investments. They were putting money in just the stable funds and in cash, and they were not performing very well. And so what we did is we introduced a target retirement fund into the plan. Okay, so then a financial person came in and sat down with each person and then explained to them what these target retirement funds are and how they work and why they're effective. Kind of did an asset allocation lesson with each one of them and explaining that you need to take more risk and you can do it with these target retirement funds. And so what happened is the participation went from almost nobody putting money into the stock market to almost everybody then using a target retirement fund once they understood it. So these can be really, really good tools. So if you have a target retirement fund at your company retirement plan, or you're just a person that you're retired and you don't want to be managing, you don't want to be rebalancing, but you want to do everything right. I can only speak from experience about the Vanguard ones because those are the ones that I look at, because they're rated very, very highly, but they encompass the things that I teach in this class. They're index-based, so a target retirement fund or a life strategy fund is a fund of funds. And so what the company does is they package stock and bond funds into a portfolio. And then you put your money in and it's divided up into asset allocations that are the objective of that particular fund. So like Vanguard has life strategy growth funds. And their life strategy growth fund has a total stock market index, total international stock market index, total bond index, total international bond index. They might have an inflation protected, I don't know. But anyway, it's 90% in the stock market and like 10% in bonds. And you're locked into that. Then you have the life strategy moderate growth. And for many people who ask me about that fund, they're retiring, they want to have a diversified portfolio, they want it 60-40 balanced. That is 60% in the stock market, 40% in bonds, using those same indexes, very low expenses. And then there's the conservative one, which I think is 40-60, and then they have the income one, which is like 30-70, and you're locked into those. And then the other is, like at work, you have these target retirement funds. And a target retirement fund does the same thing. They go back, if you're 20 years old and you're looking at retiring in 40 years, you would take the year as 2022, you'd look at a target retirement fund like 2065. And what would happen is, it goes like this. When you're in your 20s, it probably stays about 90% in the stock market and about 10% in bonds. It'll stay that way probably until you're in your 40s. When you get in your 40s, then they start gradually adding a few more bonds. So you might tick up to 85% stocks, 80% stocks. When you get in your 50s, then they're probably targeting more towards about 70-30. And as you eventually get to be 5 years away, they're probably 60-40. And when you hit your target, then they're 50-50. So that's what a target retirement fund does. So many companies, you'll see most companies offer these target retirement funds. And so if you're a person that just wants to concentrate on their life and their work and all that other stuff, but you want to make sure that asset allocation is taken care of for you and diversification, most target retirement funds will do that for you. The only warning I do have, not about the Vanguard ones, but if you go back to target retirement funds, started really getting introduced in the early 2000s. And they kind of exploded in popularity. The 1990s. And they really exploded in popularity, and lots of people were putting them in. But here's what companies were doing, and they might be doing this even today. What attracts money? Performance, right? So how could you get like a target retirement fund, like, let's say the year is 2022. Let's say a 2025 target retirement fund. How could you make your 2025 target retirement fund look better than the others? By having an asset allocation that had more in equities than necessarily in bonds. This is what happened, is many of these target retirement funds that were established in the 1990s, in order to attract money, these companies had asset allocations that were like, right before retirement, were much more in the stock market than bonds, or they should have been in the stock market than bonds. And all of a sudden, when the recession of 2000 hit, these people that were in these target retirement funds, which were supposed to be conservative and balanced out, were getting smoked because the asset allocations were too aggressive. So once again, with your company, if you have a target retirement fund, it might be an attractive option, but you have to do your checklist. Number one, what is the expense ratio? So probably if they have Vanguards in there, you know the expense ratios are going to be extremely low. Maybe 10 basis points, 12 basis points, I don't know what they are with their institutional target retirement funds. I think their regular ones are about 17 basis points if you're putting them in IRAs. But if you're looking at, like, I don't know, other companies' target retirement funds, if you see expense ratios that are 1% or more, I would be a little bit leery about using a target retirement fund. I'd be shopping around and creating my own index because that's really expensive. And then look at the asset allocation. So as I said, right here, if you see a target retirement fund that's only a few years out from the year it is, and it's allocated 65 or 70% in the stock market, those are uncomfortable asset allocations for people that are just getting close to retirement. They're too aggressive. They're too aggressive. Or you might find ones that are too conservative. I don't know. But you have to look at the asset allocations and say, are the asset allocations right, in the right target for what your objective is? So you have to do some homework with them. I guess what I'm saying is, generically, the target retirement fund is a good idea, but you have to do some homework. You can't just buy it blindly. You have to be looking at things like expenses and what are the asset allocations of them. But these are really, really nice tools. So, and they're simple. Everything's taken care of. The rebalancing, automatically target retirement funds rebalance. And if you're taking money out, the managers are going to take it out of the assets that are on the high side, or take it out of cash that's coming in, and so forth. So you don't have any of those things to do. They really make investing quite simple. All right. This is an interesting chart. Actually, it was from Franklin Templeton. It shows you. It shows a time period when investments were doing really good, and it shows about this diversification and the idea of not including bonds in a portfolio. Because actually, if you look historically speaking, over a 10-year period, you might have, if you break down all the different asset classes, because this is kind of what investment people do, is there's all kinds of different boxes we put investments. Large cap growth, small cap growth, mid cap growth, international. I mean, there's all these different boxes that categorize different segments of the market, and then including bonds. You find it's amazing over 50-year periods how many of those years the top performing asset actually is bonds. It really is quite interesting. And it correlates to a lot of times with recessions and stuff like that. So it talks about diversification in these asset allocations. But basically what they did, this is a 10-year period, 1990 to 2000, and it was called Chasing the Winners. This is where people just, they disregarded asset allocation. They just put the money in the top performing asset every year, $10,000 for 10 years. Okay, so the total investment was $200,000. Doing it that way, by 2000, had grown to $716,000, had an average return of 11%. So you'd think, wow, that's got to be the winning strategy, right? Just buy the winners every year. Forget about asset allocation, forget about diversification, just buy the winning asset every year. Okay, this is the reverse of that. Every year looking at the worst performing asset. Just don't go buy the winner, just buy the worst performing asset every year, okay? So you invest the same amount, $10,000 a year, in the biggest loser you can find on an annual basis. Actually, doing that, your portfolio grew to $794,000. You made $80,000 more by buying the loser with an average return of 11.8. But if you diversify and spread it out evenly to all the assets, including bonds, you invested $200,000 across the board, it grew to almost $1 million with an average return roughly 2% more than either of the other strategies. Once again, when you go to asset allocation, you got to diversify too, making sure you're diversified. Okay, so history shows that with asset allocation, risk and return are related. So you've got to take risk. Even as in retirement, you need to take risk in order to keep up with inflation and maintain growth so you don't run out of money. Number two, the longer an investor's holding period, the lower the risk. In other words, if you stick with the stock market, the longer you stick with the stock market or you stick with the bond market, the risk goes down incrementally over the years, especially if you have a 5-year window, okay? And rebalancing reduces risk. We showed you that on that rebalancing chart. And number 4, distinguish between your attitude towards and your capacity for risk. So everybody has an attitude. When the market's doing really well, everybody's a long-term investor, aren't they? But as soon as the you-know-what hits the fan, all of a sudden they're running for the hills, they're screaming for their financial advisor, they're calling up their company retirement plan, screaming to get out, throwing any asset allocation plan, throwing every bet in investment, no matter how good it is, out the dumper. You can't do that. You've got to change your attitude and increase your capacity for risk, because it's a necessary component to being successful to reach your goals as an investor. Okay, any questions on asset allocation? Yes?
You talked about how the stock market reverts back to its mean. And can you explain what happened during the Great Depression?
Okay, her question was, there's this reversion to the mean. And stock markets, as I said, over long periods of time, you find that the mean return for the stock market is 10%. And she asked, well, what about during the Depression? Okay, the Depression was, let's see, it started in the 1920s, lasted until the 1930s. And so you're talking about like, what, 13 or 14 years? Well, we actually experienced investment-wise something like that. You know, during the Depression, do you know what the best year in the return for the stock market was? I believe it was 1933. It was in the Depression. The market returned 54%. So the total return for the stock market was terrible in the Depression. But within that, there were tremendous rallies. So the market just didn't go down and stay there. Just like that 10-year period between 2000 and 2009, the market went up multiple times to go back down. So the mean return was skewed lower. But then as we got into the 60s, we had a tremendous rally, and like the mean can go above 10% then. So as an investor, if you find and you see that the mean return for the stock market in the future gets up to 11%, you better get nervous. Because what's it telling you? It's telling you we're probably going to have a prolonged period to get the mean back. And I've been saying this because I've been looking at money market accounts and savings accounts getting zero or almost zero, and that is so far below the historical mean. So what's telling me is we're going to be in a period where we're going to have higher interest rates. Even if we have a recession, I don't think interest rates are going to collapse because we've got to revert back to that mean. So we're going to have the prolonged period of higher interest rates in order to get us back to that mean return. Unless the world has completely changed and all history means nothing. But reversion to the mean has been a basic principle of investing for many, many, many years. Yes?
In a target fund, the bond portion of the target fund, do they use both short-term, long-term bonds and balance that out?
Okay, that's a great question. One of the prices that you do pay for using the target funds or the life strategy funds is they, at least at Vanguard, they didn't do any bond strategizing. They just stayed with those bond investments.
Is that total bond fund that they use?
Yes, and I believe that total bond fund is probably down like 15% or so.
Yeah, it is.
Yeah.
Is there no short-term bonds in that bond
Okay,
fund?
yes. The total bond index is comprised of a representation of the money that's invested in the bond market. And so it does have short-term bonds in. But even short-term bonds are down 10%. So yeah, I mean, the only bonds that are, I mean, I looked at the ultra short-term bond fund that I have been talking about in this class, and that's actually down about 1.5%. But I can handle it. It's 1.5%. I was looking at the one that I was in was down 17%, and the total and the ultra is down 1.5%. I can handle that. You know what I mean? So yeah, that's one of the things that if you're going to go that route, you have to understand. But then on the other side, those funds are going to get the reward when this turns around. And because they're in intermediate, those things are going to go way up when interest rates come down. And interest rates are going to come down when inflation.
The bond market is sort of a timing market, and I don't want to mess with that. So where am I best at the total bond market?
The bond market actually, I guess what I'm saying is you can do what I did, where you move ultra short, or you can just ride it out. In other words, this bond market is going to correct itself, and it's going to correct itself very rapidly when inflation, when the economy really, really slows down. And that's coming. That's what the Federal Reserve is going to do. And so this will, 2 years or 5 years from now, this will just be a blip. But I choose to just switch around in the bond market because it's much more predictable and understandable when to do things than the stock market, which meanders all over the place. You got it? And the swings are not nearly as much.
Easy for you to say, but I don't, like I said, I don't know that I would mess with it.
And your point is extremely well taken, because I've had numerous people saying, well, gee, I've been in the Jenny Mae fund way back when you were talking about it back in the early 2000s. Should I get out of it now? And my question is, why? Oh, because it's way down. But it's a great bond fund in that the quality of the bonds in there are great. Nothing's changed on that. And it will come back. So you've written it down this far. Why change now? Right? Right. So there's two ways of doing it. It depends on what you want to do.
Like my brother talked to me in 2008, he was asking me if he should get out of the stock market. I told him
That's a whole different deal. I don't even want to talk about that. The stock market is a different deal. That is like playing with a puppy or playing with a lion. You know what I mean? The stock market is not something I'm going to fool around with. I got a strategy for it. I got an asset allocation. I'm sticking with it. The only timing I'm going to do, and I talked about this on my Facebook page, is there is going to be a point at which I will rebalance my portfolio. Because my portfolio, next statement I get from Vanguard, I'll look at it and I will see that my asset allocation went from 52% in the stock market last year when I rebalanced to probably, maybe it's down to 45 or 44% right now. At some point, I'm going to watch the same things that I'm watching that I talked about yet in last week's class. I'll be watching the jobs numbers and I'm watching the Federal Reserve. And if you refer to last week's class when I talked about the Federal Reserve rate, it's now in the mid threes. If they jack it up another 75%, they're in the red. Is that going to be enough to slow the economy? It takes time. They say it takes at least 6 months for those rate hikes to really get into the economy. Our economy is huge, and it takes time for all this to work through. In other words, the Federal Reserve rate hike is not like gasoline stations. As soon as there's bad news, they raise gas overnight, right? But how long does it take them after there's good news to lower the price on gasoline? That's there's such a delay, right? And so the Federal Reserve rate, it's going to take time. So if they raise 75 basis points, is that going to put the hammer on the economy right away? No, it's going to take time. So I'm watching the jobs numbers in particular because that's going to give me insight to what business people are doing with hiring. And if you see negative job growth, it's really going to be a signal to the Federal Reserve that they've gone far enough and that because the Federal Reserve doesn't want to push us into a deep recession, and that inflation will probably behave better and start coming down. And that'll be a good indicator for me to rebalance. That's about the most timing I will do, and I'll take money out of bonds and put it in stocks to get myself back up to maybe 52% back in the stock market again. But the bond market is a different animal. One thing I want to, yes. Go ahead.
Where do you look for the numbers of the job market? Like, is this a computer?
Yes. Have you ever heard of Google? I got Google. I turn my computer on and it says Google. I don't know what it is, but it's Google. And so then I'll say, what are the job numbers for the month of October? And they're not released yet. But when we get into November, you can follow CNBC or Bloomberg breathlessly every day, but you'll probably know when the job numbers are released, because if the job numbers come in really weak, then I think you're going to have a big rally in the stock market. because the stock market is going to say, oh, wow, the Fed won't be raising their rates anymore because the job numbers are so weak. You know what I mean? But you'll know that that's what's happened. But basically, you can Google, just Google it, and usually there's a site that links you to the job numbers. It's that simple. One thing I do want to talk about also in this lesson is I mentioned the first week, I talked about, or the second week, I talked about indexes. And so much money is invested in like index mutual funds, but also so much money is being invested in what's called ETFs. So what I want to do is explain what ETFs are, because the financial service industry loves ETFs. Why they love ETFs? Because ETFs are index products, but they trade like stocks. And that is what the financial service company and brokerage companies love. Something that people can trade. Because the more you trade, the more money they can make. You know what I mean? So I'm not saying that ETFs are bad products. I'm not saying that like VTI is the ticker symbol for the total stock market index fund. It's an ETF of the total stock market. And it is, the investments inside it are identical to Vanguard's total stock market index fund. But they are a different animal in that they are a financial product that has a limited number of shares. So, like Vanguard's total stock market index fund, unless Vanguard decides we don't want to let any more money go into it, then that'll be the number of shares of it. But basically, mutual funds, unless the company closes the mutual fund to new investors, are basically open-ended products. They accept money, they invest it, and they distribute you shares in return for the money that you put into it. So if the share price is $10 and you send $100, they take your $100 minus expenses and invest it and give you 10 shares because the share price is $10. So now that mutual fund at the end of the day has 10 more shares. An ETF is different. An ETF, the companies, what they do is they take a certain amount of seed money and they go out and buy, I don't know how many millions dollars worth of, let's say, the total stock market index. So when Vanguard created VTI, what they obviously would have done is taken seed money and let's say $100 million, for example. And so then they said, okay, we'll have 10 million shares. So the initial share price will be $10. So on the inception of the total stock market index fund, VTI, you had this perfect balance. You had assets inside of it that were worth $100 million. You had 10 million shares, which investors could buy or sell. And then the share price was $10. Okay, but once the stock market opened, then that share price was not determined by the value of the assets inside of it, like the total stock market index fund. In other words, when you invest in the total stock market index fund and you have one share, if the stock market goes up 1% that day, your share went up 1% because you own those shares that went up 1%. The market went up 1%. But if you own an ETF and the stock market goes up 1%, the share price doesn't necessarily have to go up 1%. It goes up in proportion to the demand versus the supply. Do you get that? Unlike a mutual fund. So what you can see is you can have this randomness to what happens with the share price. If everybody's asleep that day and and there was like 1,000 people that decided they wanted to sell those shares, the share price could actually go down because the demand was not equal to the supply. And so the share price goes down to get that balance. Even though the assets inside the ETF went up 1%, the share price went down because the demand wasn't there and there were sellers. So what did the financial, see now that experiment has been tried in the investment industry called closed-end mutual funds. And they were really, really stinker products. In other words, they were really not popular. And oftentimes companies that issued them, they were trading at discounts of 30%, 25% to the value of the assets inside of it. They were just not popular because they just didn't work right. And so when the financial service industry rolled out ETFs, they said, okay, we need to solve this problem. We need to find a mechanism to get the share price to align with the value of the assets inside of it. So what they did, and how they do it, is they have what's called authorized participants. Now, the authorized participant is a shadow financial service company, a bank, or whatever. I don't know what they are. It's kind of like the dark web, I guess. But anyway, what this shadow financial institution does is they put money into the ETF if it starts trading at a discount. In return for doing that, they get what's called creation units in return. And then when the ETF trades at a premium and the share price actually is above the value of the assets, then the authorized participant can take money out, give the creation units back, and make a profit on it. And so the authorized participant acts as an arbiter to make the share price stay in line with the value of the assets inside of it. How many people who are all gung-ho about these ETFs know that that's what's happening here? In other words, if you're in an ETF of the total stock market index, what happens if the authorized participant, during times of extreme stress on the markets or volatility, can't cut through and put the liquidity needed to get the asset in line? And all of a sudden, the ETF starts trading at a vast discount to the value of assets inside of it. What do you think is going to happen to the people who are following all that stuff? It's going to be panic selling, isn't there? In other words, ETFs, much like those derivatives that work so well in the financial system for how many years during the 90s and early 2000s, which were never questioned and never tested, which all of a sudden blew up in our face in 2009, we could potentially face that. And I've never seen one article ever in Barron's or Wall Street Journal or on CNBC or all those financial centers ever talking about that. And this is what jumped out to me when I educated myself about ETFs and how they worked. I said, what happens if the authorized participant, and now think about it, there has been an explosion in the number of ETFs and the amount of money that's in there, meaning there has to be even more money, shadow money, that's going to be able to come in during a major bear market or stress on the economy to make these ETFs work the way they're supposed to. So someday, hopefully it never happens, but why? What is the advantage to me of using an ETF versus an index fund where I know I'm always going to be in balance? I don't see the reward, because if you look at Vanguard's ETF of the total stock market index and their index mutual fund, you're talking about virtually the same expense ratio. So it's buyer beware with ETFs, and I'm not against them, but I don't think you necessarily need them if you got an index mutual fund that you can invest in, right? Why add that added complexity to what you're doing? Okay, I can't believe it. Time is up. Where does time go? I don't know. If you guys asked me to talk for an hour and a half on asset allocation, I'd say there's no way I could ever do it. All right, thank you, and we'll see you next week.